Hi guys. Today we will analyze Abbott Laboratories stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been an average performer in the overall market. Also recent evolutions are not positive. The short-term trend is negative, while the long-term trend is still neutral. It is advised to wait a little bit longer to see how this turns out. Strong support levels are around $100 and $88. Next strong support level is around $79. Strong resistance levels are around $105, $117 and $123. Next strong resistance levels are around $130 and $140. In the last month the stock has been trading between $101.20 and $118.20 range. It is currently trading near the lows of this range. The stock has an average volume of 5.5 million. This is a good sign as it is always nice to have a liquid stock. The stock has been in a downward trend since January 2022. Be careful. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 16% per year, for last 5 years. We see that the average profit margin of the stock has been around 10% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 146% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Abbott Company: bad, average, and good. First scenario. Abbott will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be a low, 4%. Future profit margin would be a low, 12%. Future free cash flow to net income rate would be a low, 80%. In this case, the fair value of the stock today would be $53. Second scenario. Abbott will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 6%. Future profit margin would be average, 13%. Future free cash flow to net income rate would be average, 90%. In this case, the fair value of the stock today would be $69. Third scenario. Abbott will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 8%. Future profit margin would be high, 14%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $88. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 4.31. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Abbott, analysts forecast growth rate around 8% per year in next 5 years, and future P/E around 21. Again, I will use 3 different scenarios for Abbott Company: bad, average, and good. First scenario. Abbott will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be a low, 4%. Future P/E would be a low, 17. In this case, the fair value of the stock today would be $44. Second scenario. Abbott will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 6%. Future PE would be average, 19. In this case, the fair value of the stock today would be $59. Third scenario. Abbott will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 8%. Future PE would be high, 21. In this case, the fair value of the stock today would be $77. As you can see, today the stock is overvalued, $102, even if we expect the company's high performance in future. While the company has a good profitability rating, there are some minor concerns on its financial health. Also, the stock is expected to show a small growth in revenue in the next 5 years, 6 to 8% yearly. Based on that, the stock looks overpriced at the moment. The stock has been in a downward trend since January 2022, and it can go lower, before it recovers. The company is a dividend king. I may consider buying the stock for the dividend, when the stock drops below $85. Company's strengths. Abbott Laboratories is an American diversified healthcare company that develops, manufactures and markets a wide range of medical products and services. It split off its research-based pharmaceuticals business into AbbVie in 2013. The company has also been present in India for over 100 years, through its subsidiary Abbott India Limited, and it is currently India's largest healthcare products company. Abbott has strong positions in key healthcare product categories, and has a robust product pipeline. The company recently has a strong balance sheet, and a history of robust free cash flow generation. The company introduces new products, and invests in product development and market expansion. Abbott's FreeStyle Libre blood glucose monitor franchise is one of the most compelling innovations the firm has ever launched. The addition of St. Jude's heart-focused portfolio significantly broadens Abbott's cardiac device product offering. In 2022, the recovery in physician visits and elective procedure volumes will drive strong growth in the businesses that were strongly hurt by the pandemic. Abbott's COVID-19 test sales should remain a meaningful contributor, because tests will still be needed for treatment purposes, and in regions where widespread vaccination campaigns are difficult to carry out. Abbott recently increased its dividend for the 50th consecutive years. As a result, it has joined the list of Dividend Kings. The company's return on assets of 10%, return on equity of 22% and profit margin of 17% are amongst the best returns of the industry. Risks. Lower than expected sales of over-the-counter rapid COVID-19 tests. A prolonged baby formula recall and related reputational risks. Smaller than expected growth opportunities. Weak execution on new or key product commercialization, and unfavorable currency movements. Abbott also faces operational, competitive and regulatory risks. In the near term, it faces operational risks, as it seeks to control costs while addressing supply chain issues. Compared with key medical device competitors, including Boston Scientific, Medtronic, and Edwards Lifesciences, Abbott hasn't cultivated similar revolutionary advancements. Abbott also faces a crowded field in the molecular diagnostics area, where it must go head-to-head against market leader Roche, along with energetic competitors, like QIAGEN and Hologic. The company faces pricing pressure in markets, in which it seeks reimbursement coverage for the use of its products. In certain overseas markets, reimbursement policies are set by national health agencies, such as the NHS in the UK. Abbott's medical devices are subject to pre-market review by regulators in the US, Japan, and the EU. Falling global birth rates in the wake of the pandemic would offer challenging conditions to Abbott's nutritional segment. Based on estimates for the next 5 years, the company will show a small growth in revenue. The revenue will grow by 6 to 8% on average per year. The earnings per share is expected to grow by 5 to 10% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.